Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 7th of October here in 2021. We had a bounce today in the market, and that's rallying up off this 4300 in the S&P futures. In the broader market, we see the market is pushed all the way to here. We'll come back to this in a moment, but on the broader perspective, before the jobs report, which takes place Friday morning, so that is what we'll be looking at for volatility coming up for the remainder of this week, which is just one more day. But as we push in the weekend, that jobs report pre-market could be a catalyst, or it could be just one other news event that just the markets watches or moves on by. We are, for the moment at least, behind us on the debt ceiling and the will of government shutdown or not. That was big headline news and big headline risk last week and most of this week. But that seems to be, at the time of the video, resolved, at least for the moment. Nevertheless, the market is on a relief rally, or just a little short-term bounce, and that is coming off of key levels. So for the Nasdaq, that is off the 14,400, and we just saw, we call it the roundy affectionately here in TheoTrade, but that was, as of again this video, the top of the market and the top of today's rally. And that's why round numbers, or at least key pivot points, are important. They're not magic, they're not predictive, but they do give traders targets to play for on the way up and to establish short or fade or bearish positions on the way down from an achieved target, such as the 15,000. That's those of us on the short-term intraday basis or very short-term swing trade. These are levels that aren't quite in play too much for the broad-based duration trader, but again, we like to note what's working, what's happening, what levels are in play for the videos for the next couple of sessions. And again, that includes Friday. The Dow does remain in this sideways trading range. So that is a little different. We do have, just for reference, in terms of trend, the S&P is trending up. The Nasdaq similarly, although that's a little weaker, but we cannot call the Dow in a trend. It is sideways. And that reference points, or those reference points, are about these levels. So it's 33,500, roughly speaking, and the top side just above 35,500. And for short-term trades, that is the framework to create bounce or buy trades off of lower support and target either the middle or to a higher level, which at the moment is about 35,000. So we'll watch that as short-term traders. Going forward is 35,000 in the Dow Mini Futures. Now the Russell is the one index that is clearly in its sideways range. It's a volatility box. It does have a well-defined parameters at about the 2,300, a little bit above that, and about 2,100, again, a little bit above that, for short-term trading opportunities. When the market is at the middle, it does mean it's fairly valued, and there is not really an edge to play either direction in the middle. And without a directional edge, that does give rise to different strategies such as condors or butterflies or other strategies that don't necessarily take into account a need to be right about direction. Premium selling strategies above these levels could work just fine, and that's been the case for those of you trading the Russell or the IWM. Any type of Theo Theta portfolio or Ultima type trade or selling distant premium in the future, that's going to work fine as long as the markets stay consolidated or range bound and not moving in direction plays, especially as volatility contracts. So those are big picture, higher frame, big market levels. And the jobs report, while we're on the top level, crude oil does track the market. It's an economically sensitive commodity, which means if the economy is rising, you should expect the S&P or the stock markets and the indices to rise, but crude oil would be part of that as well. There's a little bit of a specialness to crude because it has risk of squeezes or energy shortages or different events outside of economic conditions, and that's what's happening now. There's a general energy squeeze or rise in crude oil prices or energy prices in general. There's XLE, which is an ETF. But also, again, we have discussed natural gas and how it is traded very quickly, much faster than normal, doubling in price on the chart at least from really June and July. So we are seeing the natural pullback. Things do go up, but they don't go straight up, even in a strong trend. with a series of higher highs, higher lows. We don't see this go straight up, and that does give opportunities for those that do trade or put on positions, manage risk, etc., into products like this. Commodities do have a better chance to squeeze or to play directionally strongly one way or the other a little more than stocks. Stocks don't normally do something this heavily squeezed unless they are low float or low market cap names. So that's still in the background, still not resolved yet. The energy crisis or the energy squeeze, whatever term you want to use, that energy prices are being bid, and that includes natural gas, crude, and others. Gold, not so much. That still remains in its downtrend, or at least at best, sideways trend. And finally, we keep wanting to note this bond market, and that is very important to note because bonds did have a rally. This is TLT, the tradable ETF, and that is breaking to new lows, and that is pushing or continuing the broader downtrend. It might look a little better on the weekly chart, and we can see the rapid rise from late 2018 to early 2020. And from that point, remember the COVID crash, or the COVID crisis, or the pandemic crisis, took place over here, but bonds were well bid ahead of that. And with the equity market recovering, the bond market in general has fallen and continues to trade down. Of concern, and it's something we have to keep watching, are yields or interest rates. So at the same time, the bond market was traveling higher, yields on the 10-year Treasury note were precipitously falling. They fell from about 3%, that's what the 3.0 means, 3%, down to just about in the heart of the pandemic, or the beginning of 2020, and the shutdowns and all that. The yield plummeted to just about 0.5% and has rallied quickly, especially in a percent basis, going from 2% to 3%, 30 to 30% move, big, but going from 0.5% up to 1.5% is 300%. So just keep in mind, on the broader perspective in the economy, the rapidness or how fast the yields move in the percent function doesn't give time to adjust for other sectors of the economy. So that is clearly something we'll be watching, are watching, and will continue to watch in the backdrop of the equity market, which has a decent shot to fall and break as long as it trades under support levels. But that hasn't happened just yet. It's on the cusp. It really is to be seen, what I'm looking at, as the edge of the cliff. And that cliff, it's looking over, seeing if it wants to fall over the cliff, jump off the cliff. But that hasn't really happened yet. The liquidation swing, it's just been almost a month, a little more than a month, of downside action, sell-side activity. And that's relatively normal given how overbought, overextended, or expensive these markets have become. Pullbacks are natural. Guarding risk is natural. Hedging is very natural. But nothing much has said disaster and breakdown, although that will and could materialize. So please keep hedged, keep safe on your positions, portfolio, and longer duration positions. I tend to focus on the short-term plays, but on the big picture, the weekly chart can guide those decisions. I do want to highlight a couple of stocks. We'll pull this up just quickly on the weekly chart on the right and the daily chart on the left. I just want to look through some of the large market cap names. So this, just for quick reference, is a watch list. This is something you can do on the weekend or on your own time, is take a look at the broad market, either through sectors, sector analysis, or through looking at the leading market cap. And that is what drives a large part of these equity futures and the indices themselves. So it doesn't hurt to take a look just quickly with a weekly and daily perspective on some of the big names. And that would include just a few of them. Apple. So there is Apple on the daily chart and the weekly chart, still strong, but again, broader markets have pulled back. Apple is on the leading edge of that pullback, and Apple shares have fallen from 155 down to 140. But that again is not unprecedented. This has happened quite a few times recently. And so far, these were just pullbacks against a broader uptrend, not reversal signals. Microsoft has been remarkably strong, and even looking at the daily chart, that is a strong bounce support down from the 305 level to 80 Again, similar pullbacks have happened. This is normal, but we have a strong rally. But if you miss the weekly chart, and these are things that I don't look at that often, this is a very impressive, very strong, dominant uptrend. And of course, that's not without risk and not without pullbacks, but nevertheless, this is a guiding force in big market cap stocks. And just quickly, Google similarly note the pullback, and all the stocks you look at, compare these most recent month on the pullback and what that looks like on a broader or weekly chart. Don't worry about price levels, don't worry about averages or things like that. Just note the backdrop of these stocks. Amazon has actually been, as we've been noting, in a trading range. Trading range, yes. Sideways box, sideways volatility. The Russell is like that too. But it is in the context of a broader, much broader multi-year uptrend. And we'll take two more. Facebook has been a strong seller or a leader to the downside. But again, we see volatility. Volatility is a welcome addition to this persistent nonstop uptrend. It's actually expected. It's actually a good thing to see markets pull back, and give opportunities to buy the pullback or sell some puts or sell volatility, sell some options in the higher volatility event. Lots of strategies take place when an overbought market cools off or pulls back. Finally, Tesla has been its own, we call it monster of tech, but it is the smallest. If we say 800 billion in market cap is small, it's the smallest of the big names in the S&P and the Nasdaq. But nevertheless, it is continuing to move higher, but that stock has been far more volatile, far more directional, and percent movements up and down. So that's a clear direction play and a volatility play and a safety play in Tesla because of the volatility, which is calming down a little bit. Nonetheless, let's look at the jobs report. Highlight these key levels, compare the big stocks and how they pulled back and how that contributed to or was part of the broader equity pullback. Always be careful, always be safe. This is Corey Rosenblum with the Night's Theo video update for October 7th, 2021.